Hey everyone, welcome back to the channel. If you've been following the news lately, you've probably heard the phrase 10% tariff thrown around a lot in headlines, political debates, and honestly, in everyday conversations at the dinner table. But most people shrug it off, thinking it's some distant policy decision that has nothing to do with their daily lives. And that's exactly why we made this video. Because the truth is, it has everything to do with your life. Whether you're a small business owner, a regular consumer, a student, or an investor. This shift in global trade policy is going to touch you in ways you might not even realize yet. So grab a coffee, get comfortable, and let's break this down together in a way that actually makes sense. Let's start from the beginning, because context is everything here. A tariff, at its core, is simply a tax that a government places on imported goods. When a country like the United States puts a 10% tariff on products coming in from other countries, the importer pays an extra 10%. Simple enough, right? But the reason this particular tariff is making such big waves in 2026 is because of how broadly it's being applied. This isn't a targeted tariff on one specific product category, like steel or solar panels. This is a sweeping, baseline tariff. It impacts virtually every trading partner. Goods coming in from Europe, Asia, Latin America, all hit with this same 10% floor. The last time the world saw trade policy shift this aggressively was during the early days of the trade war back in the late 2010s. Even then, it wasn't this universal. What we're witnessing now is what many economists are calling a structural reset of the global trade order. Now you might be wondering, why is this happening in 2026? Why now? To answer that, we need to zoom out a little and look at the bigger picture. Over the past several years, there's been a growing frustration in many Western countries about trade imbalances. For decades, the U.S. and other developed economies opened up their markets to cheap imports. Consumers benefited from lower prices, but the manufacturing base hollowed out. Jobs moved overseas. Small towns built around factories started declining, and politicians started hearing about it loudly from their constituents. At the same time, global supply chain vulnerabilities became shockingly real. During the pandemic years, when the world suddenly couldn't get computer chips, medical supplies, or even basic consumer goods, governments woke up to the danger of being too dependent on foreign production. So the 10% tariff isn't just about economics, it's also about national security, political identity, and a genuine rethinking of what it means to be self-sufficient as a nation. It's a policy that's riding a wave of economic nationalism that's been building for years. And in 2026, that wave has finally crashed onto shore. All right, let's get into the part that probably matters most to you, who actually feels the pain here, and who might come out ahead. Because here's the thing about tariffs. They don't hit everyone equally. The effects ripple through the economy in complicated ways. And the winners and losers aren't always who you'd expect. Let's start with consumers. When the cost of importing goods goes up, companies don't just absorb that cost, they pass it on to you. So if you're buying electronics, clothing, appliances, cars, or even groceries with imported ingredients, you're very likely going to see prices creep up. Some estimates suggest that a broad 10% tariff could cost the average American household hundreds of dollars more per year in spending. That might not sound catastrophic, but for families already stretched thin, it matters enormously. Then there are small and medium-sized businesses, the ones that rely on imported components to make their products. A small manufacturer who sources parts from Taiwan or a retailer who stocks items made in Vietnam is suddenly looking at a significant jump in their cost of doing business. Unlike big corporations that have the resources to absorb shocks or pivot their supply chains quickly, smaller businesses often don't have that cushion. Some will have to raise prices, some will have to cut staff, and unfortunately, some won't survive. On the other hand, domestic manufacturers who compete with imported goods could actually see a boost. If foreign products suddenly cost more, American-made alternatives become more attractive. That's the whole theory behind tariffs. Protect your domestic industry. Whether it actually plays out that way in practice is a different story, and we'll get to that. Here's where things get really interesting and a little tense. When one major economy imposes sweeping tariffs, the rest of the world doesn't just sit back, they respond. And that response, historically, is what transforms a trade policy into a trade war. We're already seeing it happen. The European Union has signaled it's preparing retaliatory tariffs on American goods, things like agricultural products, technology, and industrial equipment. China, which has been in an ongoing trade dispute with the U.S. for years, has its own set of tools it can deploy, from tariffs to restricting exports of rare earth minerals that American tech companies desperately need. Countries in Southeast Asia are scrambling to renegotiate trade deals. And Canada and Mexico, the U.S.'s closest trading partners, are navigating a particularly complicated situation given the deep integration of their economies. What all of this means is that the global trade landscape in 2026 is becoming increasingly fragmented. Instead of one integrated global marketplace, we're moving toward a world of competing trade blocs, countries clustering together based on political alignment and economic interest. The U.S. and its allies on one side, China and its partners on another, and a growing group of countries in between trying to play both sides and maximize their own advantage. One of the most fascinating, and actually kind of hopeful, side effects of all this. Trade tension is what it's doing to global supply chains. For decades, the dominant strategy for companies are doing something called friendshoring, essentially moving production to countries that are politically aligned with the U.S., places like India, Mexico, Vietnam, and parts of Eastern Europe. Others are investing in automation and bringing production back home entirely, what's called reshoring. We're seeing billions of dollars pouring into new semiconductor fabs in Arizona, battery plants in the Midwest, and pharmaceutical manufacturing facilities across the country. This is genuinely exciting if you believe in industrial reinvestment, though it's worth noting that these factories of the future employ far fewer workers than the old ones did, which creates its own set of challenges. Let's take a step back and look at the broader economic picture. Most mainstream economists will tell you that free trade, on the whole, is a net positive for global prosperity. It allows countries to specialize in what they do best, keeps prices low for consumers, and creates interdependencies that actually reduce the likelihood of conflict. The concern with the current tariff environment is that by pulling back from that model, we risk slower global growth, higher inflation, and a world that's more divided and more volatile. The IMF and World Bank have both issued warnings about the risks of escalating trade barriers. Some projections suggest that if the current trajectory continues, with retaliatory tariffs, fragmented supply chains, and reduced global trade volumes, global GDP growth could take a meaningful hit over the next several years. For developing economies that have relied on export-led growth to lift their populations out of poverty, this could be particularly devastating. But here's the counter-argument that proponents of these policies make. The old model of free trade created winners and losers. And the losers, particularly working-class communities in developed countries, have been hurting for a long time. If tariffs can rebuild domestic manufacturing, revitalize communities, and reduce dangerous dependencies on strategic competitors, maybe the short-term pain is worth the long-term gain. It's a genuine debate, and where you land on it probably depends a lot on your values and your circumstances. So where does all of this leave us? Honestly, in a moment of real uncertainty, but also a moment of real change. The 10% tariff isn't just a number. It's a signal that the rules of the global economy are being rewritten in real time. And whether you think that's a good thing or a bad thing, the smart move is to pay attention and understand what's happening. If you're a business owner, now is the time to audit your supply chain and think about where your vulnerabilities are. If you're an investor, sectors like domestic manufacturing, infrastructure, and technology production are worth watching closely. If you're a consumer, being aware of why prices are shifting helps you make smarter decisions. And if you're just a curious person trying to make sense of a complicated world, well, you're already doing the right thing by staying informed. As always, we'd love to hear your thoughts in the comments. Do you think the 10% tariff is the right move? Do you think it's going to help or hurt ordinary people? Let's have that conversation. If you found this video useful, please give it a like and share it with someone who's been trying to understand what's going on with global trade. And if you haven't subscribed yet, now's a great time. We cover these big economic stories every week in a way that's actually accessible and human. Thanks so much for watching, and we'll see you in the next one.